question is this. If dollar yen is already near a 40-year extreme, what happens when markets begin to doubt the force of Japan's intervention threat? That is a subtle but important shift from yesterday. Yesterday's issue was the danger of a sudden intervention shock. If Japanese officials stepped in, or if traders merely suspected intervention, dollar yen could snap lower and weak yen equity trades could unwind quickly. Today, the question is more uncomfortable. The yen kept weakening, intervention risk remained a dominant headline, and one of the day's top stories argued that Japan's FX intervention is losing its market grip. That changes the interpretation. The problem is no longer just the possibility of intervention. It is whether intervention can still anchor expectations. The market moves show the tension. Dollar yen moved to about 162.65, up roughly 0.45% on the day. The Nikkei 225 rose only about 0.16%. Topics gained around 0.45%. The S&P 500 was stronger, and the US 10-year yield moved higher. In a normal weekend story, this would look supportive for Japanese equities. A weaker yen helps exporters translate overseas earnings. Strong US equities usually help risk appetite. Higher US yields can support dollar strength, which often reinforces the weak yen trade. But today's equity response was not that simple. The Nikkei did rise, but it did not behave like the yen had just delivered a clean earnings upgrade. The market is telling us that the yen has stopped being only a corporate profit variable. It is becoming a policy credibility variable. That matters because at these levels, every extra move in dollar yen carries more than one meaning. It can mean better overseas earnings for some companies. It can also mean more imported inflation. It can mean more pressure on households. It can mean more pressure on the Ministry of Finance. And it can mean a more difficult path for the Bank of Japan. The second top story today is important for that reason. It warned that Japan's yen crisis can create risks for the global bond market. That is the bridge between currency and equities. If investors think Japan has to defend the yen more aggressively, they begin asking what happens to Japanese rates, to Japanese demand for overseas bonds, and to global duration pricing. So this is not just an FX story. It is a story about whether currency pressure, rate expectations, and bond market behavior start moving together. The stock to watch is Nomura Holdings. Nomura is a good lens because it is not simply helped or hurt by a weaker yen in the same way as an exporter. It is a financial market business. It can benefit when volatility creates more trading, hedging, financing, and M&A activity. Recent reports said Nomura's wholesale unit posted record annual revenue, supported by trading and deal-making gains. Equities trading revenue also rose sharply in the final quarter. Another recent report said Nomura delivered record annual profit of 362 billion yen. That makes the stock a live test of today's market question. If yen volatility stays tradable and client activity rises, Nomura can turn this environment into revenue. But if the market starts to see Japan's policy mix as less credible, the same volatility can become a risk management problem. Investors would then focus less on trading upside and more on whether financial firms can control balance sheet, market, and client flow risk. This is why Nomura matters today. It asks whether Japan's market volatility is still productive volatility, or whether it is becoming a sign that investors need a larger risk premium. The bottom line is that Japan is not being abandoned. Both the Nikkei and topics rose. Global risk appetite was still present, but the yen story has matured into a credibility test. At 162 plus dollar yen, the market is no longer asking only who benefits from a weak currency. It is asking who can operate when currency, rates, intervention risk,